Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more educational content like this, please visit the library at adisa.org. My name is Greg Mausz, and today I have Anastasia Amoroso here with us, and she is the Chief Investment Strategist with iCapital. And we're going to be talking about private market investing versus public market investing. Anastasia, thank you for being here. You're obviously a big fan of private market investing. Can you tell us why?
Absolutely. Well, first of all, let's look at the number of opportunities in the private markets. If you look at the number of companies that are private versus public, it is about 4 times as much. So just right there, if investors are solely focused in the public markets, they're missing out a whole big universe of private companies out there. And these private companies are doing exciting things across the world, many of them in a very high-tech and high innovation industries that are disrupting and changing and shaping the world. Many of these companies are experiencing hyper growth. That is really, the value of that is accruing to the private markets right now. And Greg, you probably know this, but even years ago, the average time that a company stayed private was 6 to 8 years. Right. Now that's been extended in duration to close to 11 or 12 years. So all of a sudden, if you're solely looking in the public markets and that growth is occurring in privates, you're missing out a lot of that hyper growth. Now, good news is that 2021 has been a banner year for IPOs and M&A activity. So some of that private opportunity set is starting to show up more and more in the public markets, but the numbers still speak for themselves, and there's a lot of disruption that's still happening in the private markets.
What do you see as some of the most compelling opportunities in the private markets today?
Well, there's really a number of compelling investment opportunities in the private markets today, and these are what I call megatrends that will change and shape and disrupt the world as we know it for years to come. So there's 3 in particular that I'm focused on. First is digital transformation, second is healthcare innovation, and the third one, sustainability. So let me give you a couple of more concrete examples around each one. Digital transformation is not new, and during the pandemic, we've all gotten very close to e-commerce and cloud computing, everything. But the real digital transformation is happening in the artificial intelligence and machine learning space, and that is disrupting every vertical out there. So artificial intelligence and machine learning is really one of the most exciting opportunities within digital transformation that is disrupting every single industry vertical. One of the verticals that is disrupting is financial services, and that in and of itself is a $20 trillion disruption opportunity, and fintech is squarely capitalizing on that. And this is not to mention cryptocurrencies that's seeing a record number of funding in the private markets that is going to build out the blockchain ecosystem. Now, that's the digital transformation side. Healthcare innovation, trends that we're very excited about because there's a tremendous investment opportunity, but also opportunity for us as individuals is there's so much happening in healthcare in terms of innovation, again, in private markets. First of all, gene therapy and its opportunity to cure potentially previously uncurable diseases. There's cancer research, and then there's an opportunity for precision medicine, which is having the right treatment for the right patient at the right time. So these are all of the opportunities that a lot of the private equity funds are funding right now. And then on the other side of the spectrum, there's sustainability. How do we actually get to net zero? Because that's going to take more than wind and solar. It's going to take new innovative breakthrough technologies like carbon capture and net zero fuels. And by the way, we also need to figure out battery storage. So this is what the venture capital community, the private equity community is working on right now. And there's a wealth of innovative companies that are solving these challenges.
I'm constantly learning about new innovative companies every day. It's an exciting time to be alive, and investing in these not only provides a great return, but it can really make an impact in our world. Investors also look to private investments for inflation hedges and to guard against interest rate risks. What are you seeing in the market today as it relates to maybe private credit or real estate?
Yes, inflation that was supposed to be transitory is maybe not so transitory, is what we're starting to acknowledge. And there's ways to position for that and guard against that in the private markets. So you point out to private capital. I think this is very different from what's otherwise available in the public universe, in that most of private capital lending is done on a floating rate basis. So if you're investing in credit issued by the middle market company, it's likely tied to LIBOR and another benchmark plus a spread. And that spread today is very attractive, between 500 to 800 basis points over LIBOR. This is better, certainly, than what you can get in the publicly traded leveraged loan market. So that's a very interesting opportunity to us. And private credit certainly is riskier than some of the publicly traded counterparts, but you're getting compensated for that risk with the spread. And in an environment where you have strong economic growth, private credit, history shows, actually tended to outperform. So that's one thing that I really like in the private markets right now for inflation and potential for higher rates. The second one is real estate. It's not just used car prices that are going up, and it's not just the gasoline prices, but it's increasingly real estate inflation, whether it's multifamily housing, whether it's even parts of retail. They're starting to show signs of life in terms of market rents are going up, and the prices of some of this commercial real estate is starting to rise as well. So overall, commercial real estate is a $16 trillion market opportunity, and you have assets there like multifamily that is very tied to inflation. Hospitality, by the way, is on the riskier side of the spectrum, but the market rent for hospitality is projected to average 8% for the next several years. So talk about outpacing inflation of 2% or more. So size that appropriately, but there's a lot to do in the real estate markets.
So those were some impressive return numbers you just mentioned, but the public markets have also put forth some spectacular returns. Is it worth doing private market investing when you have all this illiquidity?
Well, we do have to acknowledge that the performance of the public markets have been outstanding. It's been fantastic. And if you look at the ratio between private markets versus public markets in terms of performance, that outperformance gap that typically accrues to private markets, it has been narrowing in recent years. There's two things to say about that. First of all, that is true that the gap has been narrowing if you look at the median or the average performance of the private equity fund manager versus, let's say, the S&P 500. But there's ways to do better than the median, and the top quartile private equity managers have certainly been putting up much more impressive numbers. The second point that I would say, yes, it is true that in a backwards looking state, public markets have done really well, but where do they go from here? Given where valuations are, given where rates are likely headed, and also given that the S&P tends to grow earnings at 7 to 10% per year. The reason why, to us, private markets are still compelling because a lot of the companies that are in private markets growing revenues, growing earnings at well above 10%. And all else equal, if I can invest in a company that's growing 30, 40, 70% versus the S&P that's growing at 10, that company is likely to outperform.
Couldn't agree with you more. That's why I'm so involved in the private markets myself. So institutions have known this, and they've been investing in private markets for decades and at quite high allocations. But we're seeing more and more products geared towards the mass affluent and the retail investor. What are you seeing out there?
I definitely see the same trend that you're mentioning, Greg, and that's right, that private markets and alternative investment generally has been reserved for institutional investors, for family offices. And you're right, looking at the allocations of pension funds and endowments, you've seen 20, 30, 40% allocations. We know that it is much less for the average private client. I think the issue has been access, and the issue has been the ease of getting into some of these alternative investments. And that's what the industry as a whole is trying to solve today. That's what we're trying to solve, is how can we make it easier? How can we make it more accessible for the average private client to access some of these opportunities in alternative investments? So I see a big shift that's coming. I see a big tide because the demand is certainly there. That the differential and the different opportunity set that we talked about, the average private client realizes it, and especially in a banner IPO year like we've had recently. So there is demand that's increasingly there, and the industry as a whole is increasingly solving the supply issue and the ease of access as well.
You're right. Couldn't agree with you more. Anastasia, thank you for joining us today.
Thank you, Greg.
And thank you for watching. For more educational content like this in the Focus on Alternatives video series, please visit ADISA.org.